This week, markets were hit from every angle: a new Iran escalation, an oil spike, a soft US jobs report, and rising fear across stocks. We break down what happened in SPY, QQQ, small caps, crude yields, and Nvidia, and why next week's inflation data could decide whether this turns into a deeper correction or a market rebound. Welcome back to the weekly market recap. Markets came into the first trading days of March hit by a fresh wave of anxiety from the Middle East, as a new escalation involving Iran pushed geopolitical risk sharply higher. What mattered right away was not just the military headline, but the fear that oil flows, shipping routes, and inflation expectations could all come under pressure at once. Brent crude spiked early in the week and briefly moved above $82 a barrel, putting global risk sentiment on edge again. The reason this hit so hard is simple. Higher oil is not just an energy story. It can lift transport costs, squeeze household spending, pressure company margins, and make central banks less flexible just when markets want easier policy. In other words, one geopolitical shock can spread across inflation, growth, and rates at the same time. That is why traders moved toward classic safe havens while more rate-sensitive and growth-sensitive parts of the market came under fresh pressure. The market reaction followed a familiar risk-off pattern. Oil moved higher, gold benefited from safety demand, and investors leaned back toward the dollar and other defensive trades. That matters because when geopolitics lifts energy prices, markets start questioning both the inflation outlook and the growth outlook at the same time. So this was much bigger than an oil headline. It was a reminder that a geopolitical shock can reprice inflation, growth, and market risk in a matter of hours. And by the end of the week, investors were already looking to the jobs report for the next big macro signal. After the Middle East shock pushed investors toward safety, the next big test came from the US jobs report on March 6th, and it landed soft. Non-farm payrolls fell by 92,000 in February, the unemployment rate held at 4.4%, and the prior 2 months were revised down by a combined 69,000. That was enough to sharpen worries that hiring momentum was losing steam. It also gave markets a reason to reopen the rate cut conversation, even with tariffs and higher oil still keeping inflation risks very much alive. Why did this matter so much? Because labor data still sit at the center of the Fed playbook. If the job market cools, the case for easier policy gets stronger. But this report arrived in a very awkward macro moment. Tariffs were already raising inflation worries, and the oil spike had added another cost shock. So investors were trying to price two opposing forces at once: weaker growth on one side, but stubborn inflation risk on the other. That is why the policy outlook stayed easier in direction, but not cleaner. There were also details inside the report that reinforced the softer read. Healthcare payrolls were hit by strike activity, while information and federal government employment continued to trend down. The broad message for markets was that labor demand looked cooler, and that kept hopes for easier policy later this year alive. So the jobs report did not settle the macro debate. It made it more tense. Growth looked softer, but inflation pressure had not gone away. And as the rest of the data came in, that same mixed picture stayed right at the center of the market story. The incoming data explained why markets still could not relax. The macro picture still looked messy. In the United States, manufacturing stayed in expansion at 52.4 in February, services jumped to 56.1, and the manufacturing prices index surged to 70.5, its highest level since June 2022. That is not a clean recession signal. It says activity was still holding up, even as price pressure was heating back up in parts of the economy. Europe told a similar story. The flash euro area inflation rate for February rose to 1.9% from 1.7%, while services inflation came in at 3.4%. That mattered because services prices are often the sticky part. So even though recession fears were building, the data still did not give markets an easy disinflation story. Bonds and rate expectations had to keep pricing both slowdown risk and inflation persistence at the same time. That is really the closing message of the week. Investors were worrying about weaker growth, but the hard macro backdrop still refused to turn cleanly soft. Demand was not collapsing, and some price signals were still running hot. That kept the bond and policy outlook unsettled. So the week still did not end with a neat answer, and as always, this is where the deeper chart work begins. Growth fears were real, but not fully confirmed. Inflation was cooler than the old peaks, but still sticky enough to keep policymakers and markets on guard. And from here, we move into the trading charts and the deeper breakdown. We are starting with the VIX, the volatility index, because this was the cleanest snapshot of the market mood into March 7th. The chart shows a sharp one-session spike in fear, with volatility jumping fast after spending much of the past year at much calmer levels. In plain language, that tells you traders were paying up for protection and bracing for bigger index swings, not leaning into a relaxed risk on tape. If tariff stress and geopolitics keep feeding inflation and growth uncertainty at the same time, a higher VIX usually means stocks stay jumpy intraday even when they try to bounce. And that is the perfect setup for the next chart. because once the fear gauge wakes up like this, the real question becomes how much damage showed up in SPY. After that VIX wake-up call, SPY, the SPDR S&P 500 ETF, is where we check the real damage. This chart shows price sitting right on top of an important rising support zone, with momentum softening and the tape still trading below the short-term moving averages. So the broad market was not in free fall, but it was clearly leaning fragile into the end of the week. If geopolitical stress keeps oil elevated, that can keep pressure on the index through the inflation channel, while growth worries stay in the background. The next clue is the squeeze setup. Volatility had been compressed, but the chart leaned bearish with RSI weak, MACD fading, and ATR starting to rise, which is exactly the kind of mix that can turn a quiet pullback into a sharper move. In plain English, SPY was coiling near support, but the pressure was building in the wrong direction. If trade policy and growth fears keep colliding, that kind of setup can break into much wider daily swings very quickly. Zooming out, this is the part that keeps the bigger picture honest. SPY was still in a golden cross structure, with the 50 days average above the 200 days average, even though price had slipped below the 50 days line. That tells you the market was dealing with a meaningful correction inside a longer-term uptrend, not a confirmed long-term trend reversal yet. And that brings us straight into QQQ, because the next question is whether big tech could still carry leadership while the macro backdrop stayed this tense. Now we move from the broad market into QQQ, the Invesco QQQ trust that tracks the Nasdaq 100 and acts like the leadership gauge for big growth stocks. This chart shows a live squeeze setup, which means volatility had compressed even as momentum started to weaken. Price was sitting above the 200 days average but still below the 50 days line, so tech was caught between long-term support and near-term resistance. That is a fragile spot when the market is dealing with tariff pressure, rising oil, and softer labor data all in the same week. If macro stress keeps building, a squeeze like this can resolve into a much sharper move than the calm setup first suggests. The next chart makes the short-term message more bearish. QQQ broke below the falling trend channel and then failed to reclaim that lower boundary, which turned the old support area into resistance. In plain English, rebounds are being sold instead of turning into clean recoveries. If rates stay jumpy and energy keeps feeding inflation worries, that failed re-entry can keep pressure on the highest multiple part of the market. Zooming out, the bigger trend had not fully broken yet. QQQ was still in a golden cross structure, with the 50 days average above the 200 days average, but the 50 days had already started to roll over and price was trading below it. So this was still a long-term uptrend on paper, but one that was clearly under stress as the week ended. And that is the right handoff into IWM, because when tech leadership wobbles like this, small caps usually feel the macro pressure even faster. After QQQ showed big tech under pressure, IWM, the iShares Russell 2000 ETF, tells us how the more economically sensitive part of the market handled the same week. This chart shows average true range pushing to a 10-month high, which means daily moves in small caps were getting much wider. That is usually a sign the tape is becoming harder to hold, especially when financing conditions and growth expectations are both under stress. If yields stay elevated and volatility remains hot, small caps usually feel that squeeze faster than the mega caps do. The next chart puts real structure around that weakness. IWM closed at a fresh pullback, low of more than 5% from its swing high, and the drawdown had reached about 7% by March 6th, so this was not just noise inside a calm uptrend anymore. If the softer jobs backdrop keeps weighing on growth expectations, that kind of drawdown can make traders much less willing to chase rebounds in small caps. Here is the key tactical level. Price was sitting just above support near the lower part of the channel, while momentum was bearish and volume had picked up, so buyers were being forced to defend rather than extend. In plain language, IWM was near a possible bounce zone, but a clean break below support would have been the bearish trigger for another leg lower. And that takes us straight into crude, because if oil stays bid and inflation pressure rises again, the macro backdrop for small caps gets even tougher. Now we get to CL equals F, front-month crude oil futures, and this was the macro chart that changed the whole tone of the week. The signal here is simple. Volatility exploded, with ATR at a 40-month high as price broke higher with heavy participation. That tells you oil was not just drifting up, it was repricing fast enough to hit inflation expectations, risk appetite, and sector leadership all at once. If Middle East escalation risk keeps adding supply fear, oil can stay a direct source of pressure on stocks and on the rate outlook. The next chart shows why this move mattered beyond a one-day headline reaction. Crude broke out with volume confirmation, which is exactly the kind of setup that suggests buyers were chasing the move rather than fading it. In plain language, the market was treating higher oil as a real regime shift, not just a temporary spike. If that breakout keeps holding, the inflation story gets harder for the broader market to ignore. After crude became the macro shock, TNX, the CBOE 10 years Treasury Note Yield Index, showed how bonds were processing the tension. This chart shows a range expansion day with ATR at a 5 months high, which tells you yield volatility was picking up even without a confirmed long-term breakout. In plain language, the rate market was getting less comfortable and much more reactive. If oil keeps lifting inflation fears while growth data soften, yields can swing harder as traders keep repricing which risk matters more. The bigger backdrop still lean cautious on yields. This chart shows a death cross, with the 50 days average below the 200 days average and both still declining, so the longer trend was still lower even as price moved close to the 200 days line. That fits a market still reacting to softer labor signals and reopening rate cut hopes. But being this close to long-term resistance also means the move in yields was becoming more important to watch, not less. The tactical picture is where the real tug-of-war shows up. TNX was trading inside a rising channel with momentum improving, but price was also pressing against the 50 days average, so the bounce case still needed confirmation. In other words, yields were trying to recover from the lower part of the structure without fully winning back control. And that is the perfect bridge into Nvidia, because when yields stop falling cleanly, the market has to find out whether AI leadership can still carry tech. Now we get to Nvidia, the stock that still matters most for the AI trade and for semiconductor leadership more broadly. This chart shows a golden cross still in place, with the 50 days moving average above the 200 days and both still rising, even though price had slipped below the 50 days line by March 6th. That is an important distinction because it says the long-term uptrend was still intact while the stock worked through a real pullback. In plain language, leadership was under pressure, but it was not broken on the bigger time frame. After the rate debate in the last chapter, that made Nvidia the key test for whether growth investors would keep defending AI exposure. The next chart is where the tactical battle shows up. Nvidia was sitting in the lower part of its rising channel, only a few percent above support, with RSI neutral but falling and price below the short-term averages while still above the 200 days line. So the message was straightforward: buyers still had a level to defend, but a break below that support would have been the bearish trigger. If the broader market keeps dealing with tariff pressure and oil-driven inflation worries, this is exactly the kind of setup where failed support can hit Nasdaq sentiment fast. Finally, this chart captures the tone into the close. Nvidia finished in the lower part of its daily range, which tells you sellers had control late in the session rather than buyers stepping in for a strong recovery. That does not cancel the longer-term bullish structure, but it does show momentum had turned fragile by the end of the week. And that is the right handoff into the economic calendar. Because from here, the next question is whether incoming macro events help leadership stabilize or add another layer of pressure. To close it out, let's look at the week ahead. The calendar is loaded with inflation and growth checkpoints. The first big cluster lands on Wednesday, March 11th with CPI and core CPI, and that matters because markets are already wrestling with tariff pressure, higher oil, and softer labor signals at the same time. Then on Friday, March 13th, traders get core PCE, GDP annualized, and Michigan consumer sentiment, which means the market will be forced to reprice both inflation and growth again before the week is over. If inflation prints hotter than expected, yields and volatility could stay elevated. But if growth data disappoint more than inflation rises, rate cut expectations could build again. After the pressure we just saw in Nvidia and the broader market, this is the calendar that decides whether macro stress cools down or tightens its grip. That is the real takeaway from March 2nd through 7th. The market spent the week caught between softer growth signals and fresh inflation pressure, with tariffs, higher oil, and a sharp volatility spike all hitting at once. Big tech and the major indices were still trying to defend their bigger trend structures, but the tone clearly turned more fragile by the end of the week. So for now, this is a market that still has leadership, but it is trading with much less room for error. Thanks for watching. That was your weekly market recap for March 2nd through 7th. Stay sharp, manage the risk, and I will see you in the next one.